In this video, we're going to be taking a look at the best BlackRock ETFs. Now, if you ask me why I'm making this video, well, it's because there's little to no videos out there that talk about the best BlackRock ETFs. But if you look at the best Vanguard ETFs, there's already plenty. So if I make a video that talks about Vanguard ETFs, it's going to be kind of useless because there's already a plethora of content out there. Now, before we actually get into the meat of this video or the contents of it, I think it's important for us to understand what an ETF is, how it works, and why people buy ETFs in the first place. So, an ETF at its most simplest form is simply a security that tracks a specific benchmark index. Now, this benchmark index is basically a snapshot of the performance of a specific asset class. It can be stocks, bonds, even commodities. Now, how does an ETF actually work? So for example, I buy one share of BlackRock's S&P 500 ETF. By buying just one share of BlackRock's S&P 500 ETF, I theoretically own 500 of the largest US companies. Now, there's basically two reasons why people buy ETFs. One, for the low fees, two, for diversification. So when it comes to the low fees, you're gonna get an expense fee of about 0.01% to 0.10% within that range. Now, a 0.03% kind of fee, it's extremely low relative to what traditional mutual fund managers or active investors charge. So for active investors, they charge 1% to 2%. So for every $10,000 that you invest, they're going to charge you $100 to $200. Whereas for ETFs, for example, a fee of 0.03% is going to be $3 only if you invest $10,000. Now, the next reason why people invest in ETFs is because of their diversification. So this is how diversification works. Let's say, for example, one company in that S&P 500 ETF goes bankrupt, or they face some kind of scandal, or for example, bad news hits that company. You still have 499 companies to carry the weight of that ETF. So it's not going to blow up your entire portfolio and you won't lose all of your money. Now that we understand what an ETF is, how it works, and why people buy it, we can now get into this video. Now, if you've seen my previous video talking about dividend ETFs, there's basically two things that I tell you guys to look at when you're considering investing in ETFs, or you're just shopping for ETFs in general. Now, the first thing that you have to look at is the expense ratio of the fund. Make sure it's low. And the second thing that you have to look at is the fund's holdings. Now, my first recommendation for you guys is the iShares Core S&P Total US Stock Market ETF. It has the ticker symbol ITOT. So by being invested in this fund, you'll get an exposure to a collection of roughly 3,550 stocks. So that's about 7 times the number of stocks that you'd own if you were to buy an S&P 500 ETF. Now, the difference between the S&P 500 ETF and a total US stock market ETF is that for the former, you're only exposed towards large cap stocks. And for the latter, the total US stock market ETF, you're exposed towards small cap, mid cap, and large cap stocks. And the thing that you have to understand here is that small cap stocks have outperformed large cap stocks by 2 percentage points historically. Okay, so by being invested here, you also get the gains from small cap and mid cap stocks, which is really great. Now, the expense ratio of this fund is extremely low, 0.03%. So for every $10,000 that you invest in this fund, you're only going to pay $3 to continue holding it. Now, if we look at the holdings of this fund, we have Apple, Microsoft, Amazon, Facebook. A lot of these companies, they're very well capitalized. They're run by great people and they're cash machines. And they have a very good moat around them, and management's also great. And the profit margins are also high, except for Tesla, okay? For the most part, the companies, stuff that I said apply to almost all of the companies except for Tesla. It's because Tesla is included in the S&P 500. That's why their weighting here is pretty massive. And what you have to understand about Tesla, guys, is that Tesla stock price is very far divorced from its underlying fundamentals. Now, I don't have a personal vendetta against Tesla. It's just that it has to correct itself sooner or later. Now, my next recommendation for you guys is the iShares Core MSCI Total International Stock ETF. Now, something that you have to understand about diversification is that it's not just the number of stocks or ETFs that you have in your investment portfolio. It's also about the type of assets that you hold and the markets in which you own them. Now, in recent years, US large cap stocks have outperformed virtually every other type of investment. Well down to the list would be international stocks, which have really gotten a bad rep from investors because of the recent underperformance. But the thing is, that's not going to be the case forever. And by investing in an international ETF, you're also avoiding home country bias. So you own around 4,300 stocks across 50 countries, with the largest weightings in financials, consumer discretionary, in industrials. So you get exposure towards, the developed markets like Japan, UK, Germany, and you also own stocks from emerging market countries like China, and also countries from, Latin America, Africa, and Europe. Now, if by investing in this fund, the expense fee is 0.09%, very low. So if you invest $10,000, you're only going to pay $9 to hold this fund. See, if you look at the holdings here, these are very prominent and well-established companies like Alibaba, Taiwan Semiconductor Manufacturing, Tencent Holdings. So you can see companies from Korea, Taiwan, China are here. Now, my next recommendation for you guys is the iShares Core Dividend Growth ETF. Now, this ETF is primarily targeting people who want that investment yield, because in the zero interest rate environment, a lot of people are starving for yield. Okay. Now, if you look at this expense ratio, 0.08%, that's also very low. Now let's check the dividend yield here. The dividend yield is 2.27%. Now, that may seem very low for a lot of people, but you have to understand that we're in a zero interest rate environment, which means it's not very profitable to put your money in a savings account or US Treasury bonds. Now, the 10-year US Treasury bonds, the yield of that bond is around 0.91%. That's extremely low. It's not even 1%. So if you compare that to this, you're getting a lot of yield for investing in this ETF. And if we look at the holdings of this ETF, the top three holdings, JP Morgan, Chevron, Apple, these are all very great companies, okay? I think you know JP Morgan as the largest bank in the United States in terms of assets under management. Apple, everybody has heard of Apple. You're probably looking at this video in an Apple device. My only problem here, a little bit, is Chevron Corporation, because oil's been hit in this pandemic, and Chevron has taken a lot of loans in order to keep its operations going, and it's going to continue to struggle if oil doesn't get back to at least $50. So that's my only trepidation with regard to this fund or ETF. But still, a lot of these companies, they've been paying dividends for a very long period of time. So this ETF is very well diversified, and you're sure that it's not gonna blow up. Okay, one company going under is not going to affect the ETF in a profound way. Now let's take a look at the iShares Core US Aggregate Bond ETF. It has a ticker symbol of AGG. Now it has an expense ratio of 0.04%, which again, that is extremely low if you ask me. Now, here's the thing about bonds. Like I said earlier, in a zero interest rate environment, a lot of people are not really buying bonds because it's not profitable to hold them. But again, we have to diversify our holdings here, okay? It's not enough that you only have stocks.
Now, the investment objective of this ETF is to track the investment results of an index composed of the total US investment grade bond market. Now, the thing about um, investment grade bonds is that they're the highest quality bonds. So investment grade bonds, basically the ratings are from ranging from triple B to triple A. So the likelihood that these bonds will miss interest payments or eventually pay back the principal investment, it's very minuscule. Now, if you look at the holdings, it's mostly um, treasury bonds. Okay, so the chances of the U.S. government defaulting from their bonds, it's very minuscule, and you can see the varying maturities here, the expiration of the bonds. Now let's take a look at the iShares TIPS bond ETF. So TIPS, for those of you who don't know, that basically means Treasury Inflation Protected Securities. So the thing about TIPS is that when inflation goes up, the value or the principal of the bond also goes up. So you don't lose purchasing power when inflation arises. Now, what you have to understand compared to the normal bond is that the yield on TIPS, because it gives you protection from inflation, is much lower. The expense ratio is still pretty reasonable. It's slightly higher, but then again, it protects you from inflation. That's the whole um, idea behind this bond. See, if you look at the investment objective here, it seeks to track the investment results of an index composed of inflation-protected U.S. Treasury bonds. So it only has like 47 holdings, yeah, because again, its whole objective is just to protect you from inflation. So U.S. Treasury bonds to hedge against inflation. Now, if you're not comfortable holding this as a hedge against inflation, you can also invest in the iShares Gold Trust. So this ETF, in a nutshell, it tracks the price of gold. Now, here's the thing that you have to understand, guys. Gold historically has performed very well against inflation. So when inflation runs out of control, the price of gold also goes up. So this ETF's price will also go up when inflation runs rampant. And this is a problem that a lot of people are facing, or a problem that a lot of people might face because of the printing of money of the Federal Reserve, to stimulate the economy and to support the economy from weakness. So an expense fee of 0.25% it's a very small fee, to insulate you from inflation. Just think of it as a small premium that you have to pay in order to protect your portfolio from inflation. Thank you guys for watching this video. If you appreciate it, leave a like, consider subscribing to this channel, and maybe if you're generous, share it with your friends. And I'll see you guys again next week.